So looking forward, what do we forecast? Basically, the black line there is unemployment. So we've got unemployment at around 6.25, and broadly what we're saying is it's peaked. So the non-mining sector is generating enough jobs at present per month to basically stabilise the unemployment rate. Not a lot, and the statistician every now and again gets his numbers wrong, which causes grief. So, you know, you suddenly Reserve Bank puts out a forecast unchanged at 6 forever, and the next day the statistician published 6.3. So I think the bottom line, though, is unemployment is going to come down a little bit as we go forward, but it's still around 6% in 12 to 18 months' time, which sort of says it's not going to get worse, but it's not going to get much better. So my last comment is about interest rates. Oh, inflation, by the way. Don't worry about inflation. It's way under the Reserve Bank's forecast 2.5%, which is the midpoint of its forecast forever. We've got a similar sort of story in terms of where we think our models say inflation should be vis-a-vis where they're going, but they're never anywhere near 3. So from the Reserve Bank's point of view, don't worry about inflation. So rates. Put simply, we think they're on hold. Now, if the economy turns out worse and unemployment's going to 6.5 or 6.75, they're cutting again to try and again to stimulate the economy. They don't want to cut because what you're really doing with debt is you're basically lowering the price on debt when no one wants debt. So it's not very effective in terms of what's happening. So it's also very effective in terms of increasing house prices in the investor markets. And we're not sure that, you know, when we look at the markets, that the 10% APRA cap is going to necessarily help that much. They may do other things. They may change. Like, we've got the same sort of story over in New Zealand, where the Christchurch market is more expensive than Sydney. And so what do? They have all sorts of loan to valuation ratios. Recently, what they've basically turned around and said, right, if you want a loan in Auckland, you need 30% deposit before you go and talk to a bank. It's still not working. So from my point of view, where the Reserve Bank is, they're happy. They like the idea that the economy might be picking up a bit. They're still worried about this medium-term thing that nobody wants to invest in the medium term. So yes, you could get another cut, and the market's sort of got about half of a cut priced in. We're happy to say we don't think that's right. Where we think it's going to take before they actually move is a long time, because unemployment's going to stay high. So we have the next rate rise at the end of next year. Okay, and the market's priced no rate rises at all, but I think there will be one. The other thing I'd say is we think they're going to be fairly moderate in terms of what they do in rates. So economists used to say around 5 to 5.5% for cash rates would be basically neutral. So think of cash rates today at 2, so that's 3.5. We actually think the total neutral rate these days is more like 3, 3.5. So we have about 150 basis points priced in over the next 3 years or 4 years. So when they go, they're going to go slowly. They're going to go very carefully. So hopefully I haven't sort of made you feel unhappy. It's actually a better news story than what I've been telling for a while. And it's a much better news story than if I was addressing you guys in Perth. That's not such a good story. So I might stop there, and I think we're now moving into the panel session.